So we'll be looking at bond valuation today. Now, this is something we have done some way, somehow, when we're calculating cost of debt. So you'll be seeing some of the things we've done already here. But this one is focused entirely on valuing bonds. So bond itself, we know what bond is. Bonds are instruments where the issuer, the parties to a bond, we have the issuer, right? We also have, the issuer is the person that is borrowing. You don't get it confused. If you're issuing bonds, you are the person that wants to borrow money. So you are issuing to, let's say who? A lender. Maybe these are majorly the parties to a bond. The issuer is the person that wants to borrow. So he gets this bond certificate, he now issues it, and in exchange to whoever he gives it to, the person will give him some money, right? The person is buying the bonds. So the person that is buying it, that's the investor or the lender or the holder. So what this person is expecting is, I've given you this money today, you pay me interest over the life of the bond, then you now return my main money to me if it is redeemable. Then characteristics or the types of bond, anyhow you want to put it, these are the terms we need to be conversant with before we delve into the computations. So the first thing is the par value. Here, our par value. Now, I've heard of par value before, usually in terms of shares. The par value of a bond is what is stated on the face of the bond. The bond itself is like a certificate. I know most of us would have seen a bond certificate before. It's like a certificate. So the value on it, which will usually be either 100, 1 naira, 10 naira, 1,000, in that range. That's how bonds usually come. So that amount on it is the face value, the par value. Usually it will be 100, 1,000, 10,000, right? Then the coupon rate. The coupon rate is the interest that the bond is paying. Now, if we have two parties, we have A and B. So let's say Mary PLC. Now, Mary PLC needs some money so that they want to issue bonds. If they issue, here comes a lender. Who is the lender? Okay, lender is Mr. Philip. So, Mr. Philip has some money he wants to invest. If he buys the bonds Mary PLC is issuing, right, he becomes the lender. The issuer, Mary PLC, who is the what? Who is the borrower? Please don't get it confused. The person that is issuing the bond is the person that is borrowing. Now, how it will be structured is, if I give you this money, let's say he's investing only 1,000. If I give you this money, you'll be giving me interest at the end of, if it is for a 5-year period, you'll be giving me interest for 5 years. Then at the end of that 5 years, you return my 1,000 to me. No complications, where there are no complications. So that interest that you'll be receiving every year is what we call the coupon rate. So the next thing we have is the floating rate bonds. We have zero coupon bonds. Now for a floating rate bond, what it's saying is that the interest rate is not fixed. It fluctuates. Coming to this example, the interest rate that Mary PLC will be giving Mr. Philip is, let's say, 7%. Now that's the interest rate that by agreement, should be giving him. So at the end of every year, he'll be expecting what? 7% on 1,000. That's how it's supposed to be. That's it. Now for a floating rate bond, this 7% is not fixed. What we are saying is that as at the time you entered the contract, you are entering, it might change. If it is for a 6-month period now, let's say for the first, from January to end of June, he will be entitled to interest at 7%. After that, it will now change at that point. We'll now look at if they are following it based on the risk-free rate or the LIBOR rate, which I believe we discussed some time ago. If they are following that as the basis of it, they will now rechange it to what is prevailing at that period. That's what the floating rate bond is. The interest rate is not fixed at all. So for a zero coupon bond, now a zero coupon bond does not pay interest. There is no interest attached here. So what a zero coupon bond is, what you are buying it for will usually be less than what it will be redeemed for. Zero coupon bonds are usually treasury bills of government. If the face value is 1,000, if you are buying it today, you are going to buy it at maybe, let's say, 850 or 900. So over the maturity, you might get back the face value. So you see, that's your interest. Your interest is that difference between how much you invested and the par value you have been doing it at the end. Then we have callable bonds. Now, for a callable bond, this one is usually a right that the issuer has. Remember, the issuer is the person that is issuing, so it's the issuer that will pay interest. Now, if a bond is callable, where interest rates are reducing, we have a period of, let's say this is 2023, and 2023, for the entire interest rate is 7%. Now, if it is a fixed rate bond, over that 5-year period, you pay 7%. But if it is a callable bond, at any point in time, let's say the general interest rate has now reduced from 7% to what? To 5%. Now, the issuer has the right to repurchase the bond from you. So, you see, if you can repurchase it, so for a puttable bond is the opposite of a callable bond. This time around, it is a right that the bondholder is the lender. In this our short illustration, Mr. Philip, right? So Mr. Philip has that right to sell the bond. He has the right to sell the bond back to the person he bought it for. Now, when will he do this? Usually when interest rates are getting high. Now, he already entered into this agreement with Mary PLC and the interest rate is 7%. Now, the interest rate should start increasing to maybe 10%. Remember, he will be receiving 7% for over 5 years. But if it is a puttable bond, once interest rates are maybe like 10%, and Mary PLC is only giving him 7%, he will exercise that right. He will sell it back to the issuer, so he can benefit from what? The new interest rate that is prevailing in the market. So we have premium bonds. A premium bond has its market value greater than its par value. So when the market value of a bond is greater than the par value, it is a premium bond. Now, exact opposite to it is a discount bond. Then we have par bonds. For par bonds, the market values are the same with the par value. So now, the crux of the issue is in the valuation of the bonds. You know, when we say we are trying to value something, right? That is where the issue is. Now, some time ago when we were treating business valuations, I introduced something to us. It's not even just about business valuations, anything. We said if you want to value something, if you want to find the market value of any asset at all, what do you consider? Now, if you want to find the market value of anything, we are saying consider the cash flow. Anything at all, your phone, the market value of your phone is what it can do in future. The market value of your car is all the benefits you can get from that car till the end of its life. The market value of an equity share is all the dividends you can get from that share till the end. The same thing applies to a bond. The market value of a bond is all the interest you are going to receive, all the interest you are going to receive over the life of the bond. That is what you consider. So I told you now, this person had a piece of paper, somebody wants to buy it. Before you can sell it, you have to consider all the inflow, the cash flow that will come because of the asset. The same thing applies to a bond. Whenever you want to value a bond, you look at all the cash flow that you can get because of that bond. That will be the what? That will be the value. But then we cannot take it that way without discounting, We have to get the present value. When you now add all these present values together, you now have the market value. That's the same thing that applies to a bond. If you want to find the present value of the market value of a bond, right? The price of any asset is, look at my notes here. You say the price of any asset is equal to the present value of the expected cash flows from the asset. Now, this same principle is applied in valuing bonds with the cash flows discounted using the bond's yield to maturity. In finding the value of a bond, just like our equity shares, anything at all, as long as you are an SFM, if you are being told what is the market value of something, all you need to do is look at all the cash flow, we are not talking of profit, so all the cash flow that accrue to that asset, you discount it, now give you the market value. So let's look at this in illustrations. a bond with a face value of 1,000. I've explained what face value was just now. A bond with a face value of 1,000, an annual coupon of 8%. Now, this annual coupon, if we are treating bond valuation, please, you keep seeing things like coupon. Coupon is what? Is interest. Coupon of 8%. That means this bond is paying interest of 8%. If the bond yield to maturity is 10% and with a maturity period of 5 years, compute the current market value of the bond. Now, this yield to maturity, we'll still look at it. I don't want to talk about it now. But for now, where we are, just know that the yield to maturity is like the returns, right? If the bond yield to maturity of 10%, okay, this English is, we compute the current market value of the bond. And I said we'll still discuss this in detail, but just take it now. Yield to maturity is like our cost. If you want to discount, you use it. YTM 10% and maturity of 5 years. We should compute the current market value of the bond. Now, remember we said the value, to find the value of something, you look at what? All the cash flow, Abi? Now that cash flow, just take it like that. You must find the present value. So ideally what we are doing is trying to find the present value. So for this particular bond, in the year 1, let's say this is year, Abi? So in year 1, what will happen? There will be a cash flow. A cash flow of what? A cash flow of the interest. Or let's find the interest. From this question, the first thing you have to do is what? Find that interest. The interest that will come in year after year. The face value is 1,000 naira. And it pays interest of what? At 8%. So what will be our interest per year? So our interest is basically our 1,000, maybe by what? 8%. Or 8 divided by 100. So what will that give us? That will give us 8. So interest is 100 times 8%, that's 80. So every year, our cash flow is going to be 80. The first one we have is year 1 to 5. Alright, so for year 1 to 5, we know the cash flow will be what? 80, which is the interest. Now, what we are using here is what? Our cumulative discounting factor. Now, what is the cumulative discounting factor for year 1 to 5 at 10%? We all know the formula to use now, Abi? 3.791. Now, what is the present value? Now, then in year 5, we also receive something, Abi. We also receive our redemption, 1,000. So, what's discounting factor? 0.621. 1,000 times 0.621. Okay, this one is 621 directly. So, our market value is the summation of what? These two, right? So when we sum it, what do we have? So this is as simple as it can get. Now, where bond valuation will get complicated is when we have some factors that are coming into play. That's where, but the entire idea is always what? Around this. Okay, and when we have to find this 10% also, we know it as our cost. When we have to find that 10%, that's where another one is. Alright, so let's continue. Now, this is for a what? A bond that can be redeemed, right? A 5-year maturity. If it is irredeemable, we know what to do now, Abi? If it were irredeemable, if you want to find the market value, what am I supposed to have done? All facts are the same, but then this 5-year maturity period does not exist. This will exist into perpetuity. That means we are not going to get this 1,000 back. What we'll be getting is our what? Our 80. But we are getting this 80 into the foreseeable future. So what you are just doing is what? 80 divided by 10%. Annuity into perpetuity. You know annuity into perpetuity, the formula is, if you want to get it direct, A over R or A times 1 over R. Both of them works, right? So if you were asked to find the market value of an irredeemable bond, then here, if we are not going to get our 1,000 back, what we are just finding is what? Is the present value of this 80 over 5 years. But irredeemable, you do not know that it is 5 years, so you cannot use this year, because this one is limiting your discounting to 5 years. So you have to discount it into perpetuity. That's why we use the annuities perpetuity formula, which is A over R. So if it were irredeemable, it would just be 80 divided by 0.1. I hope you people get it now. Now, if you want to find the market, please, you use IRR when you want to get the return. But when you want to get the market value, you do not use because in using IRR, you have to use this. So this will be what we use in year 0, the market price. In year 0, you have to do IRR. So you see, it's not really the same thing. Now, the market price of 0 coupon bond. Now, if it were a 0 coupon bond, if you remember, I said a 0 coupon bond is what? A 0 coupon bond does not pay interest. So essentially, what you are getting is how much you are paying in the beginning, and we are comparing it to what? How much you are getting at the end, which is the par value. So if you want to find the present value of a 0 coupon bond, there is only one cash flow. Is that also? If this was 0 coupon now, that means from year 1 to year 5, this 18 naira won't exist. If it's a 0 coupon bond, this is the only thing that we'll get in year 5. So this is the only thing we are going to what? Discount. And that will give us the market value of a 0 coupon bond. As simple as that.
I believe you are enjoying the video, right? Yeah, so you can get the complete video when you enroll for our quality virtual classes or opt in for the video lectures for ICANN, CITN, and ACC exams at Excel Academy. So send a message to the number showing on your screen on WhatsApp to enroll. And I look forward to having you in the classes. Thank you.